Most people have been trained to think about retirement in one very narrow way. You save money, put money into the stock market, hope the account balance grows, and then someday, when the paycheck stops, you start pulling money out and pray it lasts long enough. That is the normal retirement story, but here is the problem. Normal does not always mean effective. For a lot of Gen X investors, especially people in their late 40s and 50s, that old retirement story is starting to feel a little thin. The kids are older, the career has hopefully stabilized, the mortgage may be under control, and maybe the debt picture is better than it used to be. You may have worked hard, done the responsible thing, followed the rules, and tried to be smart with your money, but there is still one question sitting there like an unpaid bill on the kitchen table. Will I actually have enough income when I stop working? Notice I said income, not account balance. Not financial theory, not colorful charts, not some glossy retirement brochure that assumes everything goes according to plan. I am talking about actual monthly income, because when the paycheck stops, your life does not stop. Groceries, insurance, utilities, property taxes, and medical expenses keep showing up. And if you have kids or grandkids, life has a funny way of continuing to need money. That is where real estate starts to enter the conversation. Not because real estate is magical, because it is not. Not because rental property is passive, because most of the time it is not. And not because owning property automatically makes somebody wealthy, because it absolutely does not. Real estate belongs in the retirement conversation because it can produce something many traditional retirement accounts do not naturally produce very well. Durable, controllable, income-producing cash flow. The question is not just how much money do I have saved? The better question is, what income systems have I built? That is a very different conversation, and it is the conversation more people need to have before they get too close to retirement and realize that a pile of money is not the same thing as a plan for monthly income. But before we get too excited, we need to slow down and draw a very important distinction. Owning real estate for retirement and owning real estate inside a retirement plan are not the same thing. That distinction matters a lot because one path can give you more flexibility, usable income, financing options, tax benefits, depreciation, and direct control. The other path may offer long-term tax advantages, but it can also come with strict rules, prohibited transaction risks, custodian requirements, possible debt-financed income complications, and a lot less personal flexibility. So today we are going to walk through the question, should you own real estate in your retirement plan? My answer is going to be very real estate professional, very conservative, and probably a little annoying if you were hoping for a simple yes or no. The answer is maybe. But should real estate be part of your retirement strategy? For many people, yes. Those two things are not the same, and confusing them can create real problems. Real estate can absolutely be a retirement tool. A rental property can generate monthly income. A well-bought property can appreciate over time. Tenant rent can help pay down debt. Rents may increase over the years, and the property may later be refinanced, sold, exchanged, or passed down as part of a legacy plan. That is why real estate has always attracted people who want more control over their financial future. Control is the big word here. With a stock portfolio, you mostly control contributions, allocations, and withdrawals, but you do not control the company, the market, the Federal Reserve, investor sentiment, or whatever panic the financial media decides to sell this week. With real estate, you have a different type of control. You can choose the property, evaluate the neighborhood, improve the asset, increase rents over time if the market supports it, refinance strategically, manage expenses, choose better tenants, hire property management, and decide whether to hold, sell, exchange, or reposition. That control is powerful, but control cuts both ways. With real estate, you are also dealing with repairs, vacancy, tenants, insurance, property taxes, financing, local market shifts, maintenance, management, and sometimes good old-fashioned human nonsense. Stocks do not call you at 9:30 at night because the water heater failed. Tenants sometimes do. That does not make real estate bad, but it does mean you need to respect the asset class instead of treating it like some magical retirement vending machine. Before anybody says, "I want real estate in my retirement plan," they need to answer a better question. What do I actually want real estate to do? Do I want retirement income, long-term retirement growth, tax strategy, inflation resistance, diversification away from Wall Street, a legacy asset for my family? Or am I just scared of the stock market and looking for something that feels more solid? Those are different motivations, and they may require different strategies. There are generally two major ways to think about real estate and retirement. The first path is owning real estate outside the retirement account. This is the most straightforward path for many people. You personally buy a rental property, small multifamily property, duplex, fourplex, or other investment property. You manage it yourself or hire a property manager. The income, expenses, deductions, financing, depreciation, and eventual sale are handled outside your IRA or retirement plan. For a lot of investors, this is the cleaner lane. It may not always be the most tax-sheltered lane, but it is often the most practical. You can usually use traditional financing, personally guarantee the debt, potentially benefit from depreciation, make decisions directly, hire vendors, handle repairs, refinance, sell, reposition, and use the income personally, subject to taxes and your overall financial situation. In other words, it behaves more like a real-world investment property. For someone trying to build usable retirement income, that may matter more than fancy retirement account structure. I am not saying this path is automatically better. I am saying it is often simpler, more flexible, and easier to understand. In real estate, complexity is not always your friend. Sometimes the sophisticated strategy is simply owning a property that cash flows, has proper reserves, is managed correctly, and fits your long-term plan. The second path is owning real estate inside a retirement account. This is where things get more complicated. This usually involves a self-directed IRA or certain self-directed retirement arrangements that allow alternative assets, including real estate. A lot of people hear self-directed IRA real estate and they hear freedom, but that is only partially true. It is freedom inside a rule box, and that rule box has teeth. When real estate is owned inside a retirement account, the retirement account owns it, not you personally. That means the income should go into the retirement account, expenses should be paid by the retirement account, contracts need to be handled properly, and the property should not personally benefit you or other disqualified persons. You generally cannot buy a vacation home in your IRA and use it personally. You cannot sell your own property to your IRA. You cannot have your IRA buy a rental property and then let your child live there. You cannot personally do sweat equity repairs on the property like it is just another Saturday project where you grab your tools and go fix the place. That is where people get themselves into trouble, because real estate is naturally hands-on. With a normal stock portfolio, you do not accidentally go over to the company's office and fix the roof. You do not accidentally lease shares of stock to your grandson. You do not accidentally pay the plumber for your mutual fund from your personal checking account. But with real estate, those temptations are real. You own a property, something breaks, and your natural instinct is to fix it. But if the property is owned by your retirement account, you cannot treat it like your personal rental property. Here is the blunt version. If you are not detail-oriented, do not casually use a retirement account to buy real estate without professional guidance. That does not mean the strategy is bad. It means the strategy is not casual. You need qualified guidance, the right custodian, an understanding of prohibited transaction rules, clean paperwork, proper property titling, adequate reserves inside the account, and a very clear understanding of how income and expenses flow. If you mess it up, this can go from a smart alternative investment strategy to a financial ambush very quickly. I do not say that to scare you. I say it because real estate investors sometimes fall in love with clever ideas before they understand the operating rules, and that is a bad habit, especially with retirement money. Debt is another major issue. A lot of real estate investors use leverage, and that is part of the power of real estate. You buy a property with a down payment, use financing, and the tenant rent helps pay down the debt over time. If the property is bought correctly, managed correctly, and financed correctly, leverage can accelerate wealth building. But inside a retirement account, debt can create tax complications. This is where people often get surprised. They think, well, my IRA is tax advantaged, so everything inside it is clean. Not always. When a retirement account uses debt to buy real estate, part of the income may be treated differently because the property is debt financed. That does not automatically make the strategy bad, but it means the math must be real. Not guru math, not trust me bro math, not spreadsheet fantasy math where rent is always collected, tenants never leave, HVAC units live forever, insurance never goes up, and property taxes are apparently frozen in time by some magical government fairy. You need real math. Cash flow after vacancy, cash flow after repairs, cash flow after property management, cash flow after insurance, cash flow after property taxes, cash flow after compliance costs, cash flow after financing complications, cash flow after the stuff nobody wants to talk about. If the deal only works when everything goes perfectly, it is not a retirement strategy. It is a daydream with a roof. That is one of the biggest mistakes people make with real estate. They look at the purchase price and the rent and think they understand the deal. They do not. A property is not a deal because it has a tenant. A property is not a deal because someone called it an investment. A property is not a deal because the online listing says, great cash flow potential. Potential does not pay the bills. Cash flow pays the bills. And even then, only if the cash flow survives the real world. So when might owning real estate inside a retirement account make sense? It may make sense for investors who already understand real estate, have enough retirement account capital to avoid underfunding the property, work with a qualified custodian, CPA, attorney, or advisor who understands the structure, and are disciplined enough to follow the rules without treating the property casually. It may also make sense when the investor wants long-term tax-deferred or tax-advantaged growth and does not need current personal income from the property. That last part is important. If the real estate is inside the retirement account, the income generally belongs to the retirement account. That can be great for long-term compounding, but it may not help you pay your current household bills. If your goal is income you can use before retirement age, owning real estate personally may be more useful. If your goal is long-term retirement account growth, then a self-directed structure might be worth exploring. Different goal, different tool. That is really the heart of this discussion. The tool is not the strategy. Real estate is a tool. A self-directed IRA is a tool. Debt is a tool. Depreciation is a tool. Cash flow is a tool. The real question is, what job do you need the tool to perform? Now, when might real estate inside a retirement plan not make sense? It may not make sense if you need liquidity. Real estate is not liquid like a stock or mutual fund. You cannot click a button and sell a bedroom. You cannot sell half the garage because you need cash next Tuesday. It may not make sense if you hate paperwork, because this strategy requires details, documentation, clean money flow, and compliance. It may not make sense if you do not understand property operations. Real estate looks simple from the outside. Buy property, collect rent, get rich. That is the cartoon version. The real version includes underwriting, tenant screening, lease enforcement, maintenance, capital expenditures, reserves, local laws, vendor management, insurance, financing, and exit strategy. It may not make sense if you want to personally use the property. That is one of the fastest ways to cross the line. It may not make sense if you want to manage everything informally, and it definitely does not make sense if you are planning to cut corners. Retirement account real estate is not the place for cowboy investing. One of the biggest practical problems is reserves. A rental property without reserves is not an investment. It is a future emergency. Roofs fail, HVAC units die, tenants move, insurance goes up, property taxes change, appliances break, and markets soften. Stuff happens. If the property is owned inside a retirement account, the retirement account needs the ability to handle those expenses. You do not want retirement money trapped in a property that cannot support itself. That is how investors turn a smart alternative asset strategy into a financial cage. This is where I want Gen X investors especially to pay close attention, because a lot of people in their late 40s and 50s are starting to feel pressure. They are looking at retirement and realizing they may not be where they thought they would be, so they start looking for faster solutions. Real estate starts showing up everywhere. Rental property, short-term rentals, self-directed IRAs, private lending, creative finance, syndications, notes, and all kinds of alternative strategies start sounding attractive. Some of those tools can be useful, but desperation makes people sloppy, and sloppy gets expensive. Do not buy real estate because you are behind and panicking. Do not buy real estate because you are afraid of the stock market. Do not buy real estate because some guy on the internet made it sound easy while standing in front of a rented sports car. Do not buy real estate because you want to feel like you are finally doing something. Buy real estate because the numbers work. Buy real estate because the structure is clean. Buy real estate because the reserves are adequate. Buy real estate because the property fits the job you need it to perform. Buy real estate because it moves you closer to durable retirement income. Not hype, not speculation, not hope. Structure. That is the game. This is why the better question is not, should I own real estate in my retirement plan? The better question is, what job should real estate do in my retirement strategy? Do you need monthly income? Then you may be looking for cash-flowing rentals owned personally, with conservative financing and strong reserves. Do you need long-term appreciation? Then you may think differently about market selection, neighborhood trajectory, holding period, and exit strategy. Do you need inflation resistance? Then rental income and replacement cost dynamics may matter. Do you need diversification away from Wall Street? Then real estate may offer something tangible, local, and operational. Do you need legacy assets for your family? Then ownership structure, estate planning, debt strategy, and management succession matter. Do you need tax strategy? Then you need to talk with qualified tax professionals before you start moving retirement money around. Do you need something you understand better than mutual funds? Then real estate might fit your personality because you can see it, touch it, inspect it, improve it, and manage it. But none of that means real estate is automatically the answer. Real estate can build wealth, but real estate can also punish ignorance. It is a powerful tool, but it does not care about your intentions. The property does not care that you are a good person. The market does not care that you worked hard. The tenant does not care that you are trying to retire. The water heater does not care that you had a rough month. That is why real estate must be approached with respect. Here is the conservative, tell it like it is answer. Should you own real estate in your retirement plan? Maybe. Should real estate be part of your retirement strategy? For many people, yes. But do not confuse the two. Owning rental property personally may give you flexibility, usable income, financing options, tax benefits, and direct control. Owning real estate inside a self-directed retirement account may offer long-term tax advantages, but it also comes with strict rules, prohibited transaction risks, custodian requirements, possible debt-financed income issues, and less personal flexibility. The real answer is not, yes, everybody should do this. That is nonsense. The real answer is that real estate can strengthen a retirement plan only when the property produces real cash flow, the investor understands the risks, and the ownership structure matches the goal. That is the key. The ownership structure must match the goal. If you need income now, do not blindly trap the property inside a retirement account where the income is not easily usable. If you need long-term tax-advantaged growth and you have enough capital, enough reserves, and the right professional guidance, then maybe a self-directed retirement structure is worth exploring. But the goal comes first, the structure comes second, and the property comes third. Most people do it backward. They find a property, get excited, and then start asking how to make the structure work. That is backwards. Start with the job, then choose the structure, then evaluate the property. And when you evaluate the property, do not evaluate it like a dreamer. Evaluate it like an operator. Ask what the rent is, what the realistic vacancy is, what the taxes are, what the insurance costs, what repairs are likely, what capital reserves are needed, what management will cost, what the debt service looks like, what happens if rent drops, what happens if the tenant leaves, what happens if the roof needs replacement, what happens if insurance jumps, what happens if you need to sell, and what happens if you are wrong. That last question matters. What happens if you are wrong? A good retirement strategy should not depend on everything going perfectly. It should be able to survive some friction, because friction is coming. This is where I think real estate is especially powerful for the right investor. It forces you to think in systems. A lot of traditional retirement advice trains people to think in balances. How much is in the account? How much did it grow? What is the projected number? Real estate forces a different question. What does the asset produce? That is the mindset shift. A rental property is not just a balance on a statement. It is an income machine if bought and managed correctly. When you start thinking in income systems, your retirement planning changes. You stop asking only, how big is the pile? And you start asking, what produces income when I am no longer working full-time? That is why I believe real estate deserves a seat at the retirement table. Not because it replaces everything, and not because everyone should dump their retirement accounts and go buy rentals. That would be reckless. Real estate deserves a seat at the table because income-producing property can create options, and options matter in retirement. A paid-off or low-leverage rental property can create monthly income. A property with equity can create refinancing options. A well-located asset can become part of a legacy plan. A rental portfolio can create income diversity. A properly structured real estate strategy can help you move from consumer thinking to investor thinking. That is the bigger shift. This is not just about buying a property. This is about changing the way you think about retirement. Retirement is not just an age. Retirement is not just an account balance. Retirement is not just a date on the calendar. Retirement is a question of income, control, risk, structure, and options. If your retirement plan depends entirely on selling pieces of your portfolio every month and hoping the market cooperates, you may want to at least consider whether income-producing assets belong in the conversation. Again, I am not saying real estate is easy. I am saying it may be useful, and useful beats easy. Easy is usually sold to consumers. Useful is what investors look for. So here is my final answer. Yes, real estate can absolutely be part of a retirement strategy, but be careful before putting real estate inside a retirement plan. There is a difference between owning real estate for retirement and owning real estate inside a retirement account. Personally owned rental property may give you more direct control, more usable income, more financing flexibility, and potentially more practical operating freedom. Real estate inside a self-directed retirement account may give you certain long-term tax advantages, but it requires strict compliance, clean separation, professional guidance, and enough reserves to operate the property properly. Neither path is automatically right, and neither path is automatically wrong. The right answer depends on your goal, your timeline, your risk tolerance, your capital, your tax situation, your operational ability, and the actual property. Do not buy real estate because you are scared. Do not buy it because you are desperate. Do not buy it because you heard the phrase passive income and thought it meant easy money. Real estate is not magic. It is math, management, and structure. When the math works, the management is handled, and the structure is clean, real estate can become one of the most powerful retirement tools available. Not because it is easy, but because it is useful. For a lot of hardworking people who have done what they were told to do, saved what they could, paid down debt, raised families, worked careers, and still feel uncertain about the future, useful matters. You do not need to become a real estate mogul. You do not need 100 doors. You do not need hype. You need clarity, clean numbers, adequate reserves, the right structure, and maybe, just maybe, one smart door at a time. Before you put real estate inside your retirement plan, get clear on the strategy first. Start with the fundamentals: cash flow, financing, reserves, management, tax considerations, and long-term exit options. That is exactly why we created the One Door Challenge. It is designed to help you think through real estate, retirement income, and your next practical step without the hype. Start the One Door Challenge at www.christensenproperties.com/ODC. And if you are ready to talk through a specific property, retirement strategy, or real estate move, you can book a strategy call at www.christensenproperties.com. I'm Joshua Christensen with Christensen Properties, powered by R1 of New Mexico.